All right, good morning, everybody. So we made it past the CPI. Today we've got a little bit of job numbers, and we got the PPI, and that's really the biggest. A lot of auctions today, and I know that it seems like I'm the only one that really focuses on those, but to me, they have a lot of weight. So I always keep my eye out for additional things like those auctions, and which ones, of course, hold more weight than others. Today is some of my favorites. I guess I don't know if that's exactly the way I would word it, but it'll do. So we take a look at what's going on around the world. We can see is, what do they say? Green on the screen. Animal spirits are alive and well. Small caps are doing really good, and we're going to circle back to that probably if we still have time. But it's part of that fractal rotation, right? Not just like a sector rotation. But this is a really good place to start. I'm not logged in. You can see some. I guess I am logged in. Let me take that back. You don't have to be logged in. This is a place that you can go to with no account. You don't need to sign up for anything, and it just gives you a global look. You don't need a bunch of screens or extra charts. You don't need to see these nations' price action, right? Just how are they doing on the day? You glance at it from time to time and kind of get a feel for, is it decreasing on the day? Because it can start, up a lot and then fade through the day, or it could start down and then rally back. We've all been there, right? We've seen that with the indexes. So looking at it once is a good start, but circle back. If you have a hard time remembering the numbers, just take a snapshot. If you use something like I do with, say, Snagit, it'll do a screenshot for me or picture of whatever I want, really. But it tags it for me with a timestamp, so I know when I took it. And that, of course, it just saves everything automatically. I don't have to save anything. So we're doing good at the moment. We want to see how the day goes through and whether or not we're going to keep it. We got the 30-year today. That's one of my, I don't have a better word, so I'm just going to say favorite. I like that one. I pay attention to it a lot more than, say, the 4-week, right? I know that front end is what we feel, but keeping track of that 30-year, is kind of a go-to for me. And that's at 1 o'clock today. Really nothing else globally that we need to keep track of this morning. This isn't new, so I don't know why they're throwing it. So putting it in their alerts. They're still considering they're leaving the door open for more hikes if they need to, which is again that's not new, right? That's over in European Central Bank. All right, so you can see it's a full house, 8:30, 10:30, 11, 11:30, 1 o'clock. This treasury statement, I mean, it's information. I don't think it's going to surprise the market, anything like that. But it's worth being aware that at 2 o'clock we're going to get some data in. If you want to see this better, and by better I mean on Thinkorswim, you can read it. But if you click away, it falls away, right? And then you got to start all over again and try to scroll back to where you were. Thinkorswim didn't write this. It is provided to them by a company called Econoday. And so if you were to go to Google and search for the Econoday website, you'll get this exact description, but on a web page that doesn't fall away from you. And you can copy the language and paste it somewhere. You can take a screenshot of it. It's really useful information because if you continue to read through it, it'll kind of go into a little why do I care, or how's it going to affect bond traders versus equity traders. So it's not a bad place. I wanted to throw that out there because somebody asked me the other day about how do we learn more on these different events that happen throughout the day. That's one place to learn more about it. And it's free. I like free. All right, so before we get into the intraday here, the pattern isn't showing up as well here on the ES. Let's go to the SPX for a moment. Daily chart, SPX. We're looking for this gap up after hitting resistance. All right, so we set a high, we pulled back, we came back up, hit that high again, pulled back with a higher low, and then came in and had a gap up. So if we look back and we kind of ask, where did we have that same sort of situation and how did it work out with the gap up included? Maybe a little bit like right in here. We set a high, come back and we get a higher high and test against it. And then we fade back again, come up and gap up, and we kept that gap up. Right now, sure, we kind of stalled and languished there for a while, but we did keep that gap up and then we continued to go. Pre-COVID, we would have been using things like a 5% or a 7% pullback for a buy the dip kind of a play, but we've been getting more of these 2 and 3% pullbacks, right? Just TradingView has a better tool than Thinkorswim on this, but you can measure the pullback, right? Just don't click the other button. So I clicked the button to start, but I haven't finished the drawing. So we're getting this box here. So we can see the percentage of how far it pulled back. Those were the deeper pullbacks earlier in the year, but now we're getting like that 2.5% pullback there, 3% there, 3% there, which is, it's indicative of what we've got, this bullish backdrop. and that none of that seems to be ending anytime soon, right? So I mentioned that because with that gap up yesterday, it just looks like they're setting us up for a gap up and then a fail, right? And the obvious trade would be to put on like a call credit spread at the high, because we've already gapped up, made that big move. I wouldn't be so sure, especially with the things that we saw yesterday. With that move in the dollar, it's not just where we ended up, it was how fast we got there, right? That was a part of the situation yesterday, and the 10-year, right? So with both of these making moves like that to the downside and that gap up that we had, I wouldn't discount it and try to short that sucker yet. We could fade back, sure. I mean, don't get me wrong. The market can always find a way to surprise us. But my default approach would not be to short that thing. Go back to that for a second. So these are hand-drawn weekly expected moves versus the indicator, and the SPX broke outside of the weekly expected move yesterday. We gapped up outside of it, and we stayed outside of it for the whole day. That's the range, right? The number we have here, 44.5788. So if we were to look at that on the weekly expected move, this says 44.5766. Now that's not too bad. It's not too far off, right? We're going to copy and paste where that other line was. Oh yeah, look at that. 20 cents off. So this is the difference between drawing it by hand and letting the machine do it for you. Not much of a difference now, but when volatility is really high, that number will be a lot different. It will be farther away, right? So on whether or not you should draw those lines by hand or let the machine do it, the convenience is if you're looking at a lot of ticker symbols, let the machine do it, right? Otherwise, you'd be spending half of your weekend trying to draw those lines on everything everywhere. On the other hand, when it comes to something very specific like the SPX itself, it's worth doing it by hand, right? You kind of get that consistency. Someone asked me about these voodoo lines that I reference from time to time. I can't share them because they come from a company that sells indicators. And no, I didn't buy it, but the company that I worked for bought them and I got access to them. The problem is they didn't do a really good job of explaining where those lines come from. I can't replicate them because I don't understand how they were created in the first place. And occasionally we have to go back to the website and download a new version of it because the lines have moved. So it's not even updating the lines in real time by any kind of math that's in the system. They're being hand drawn by somebody and then they come out. So there's a real lack of trust for any indicator or line or pivot or anything else when you can't explain, one, where it came from and what data is in it. So I continue to reference them and I continue to watch where price is and how it responds to those levels, but one, I can't give it to you. and two, we can't duplicate it. And I code on Thinkorswim, but the code isn't showing how the lines are developed because, again, somebody's drawing them in there by hand or putting them in by hand. We tried to do an inside breakout and failed. Volume is a little light this morning considering what's on deck. You know, I would have expected with such a light morning for there to be a little more volume, but it's not low enough to be concerning, and it's certainly not, too big, so that's not an issue. A little bit of Goldilocks, we're kind of right where we should be. It just seems a little light this morning considering yesterday. Not too much of a move through the kill zone. It's been more of a grind. Speaking of the kill zone, I heard that phrase from somebody yesterday, and it was a completely different context than how I had learned about it being this move between 2 and 4 a.m. Right? That's when I was studying FX markets. I learned about this window of time between 2 and 4 that statistically has the biggest moves in the entire trading day. So if you were to measure from like 9:30 to 11:30, or from 2 to 4, or you would think the open or power hour or any other part of the day. Statistically, this 2-hour window has bigger moves than any other spot in the day. And it was coined the kill zone. What I heard somebody talking about yesterday is a choppy, nasty mess that you want to avoid. And it's a kill zone, right? It's just going to kill your account. It's going to chop you up. So it was interesting to hear that phrase used in a completely different light. So far, we have an MDP, that's a missed daily pivot, and we're a long ways away from it. There's nothing necessarily wrong with that, by the way. If you were to put on like your traditional standard floor pivot with the S1, S2, R1, R2, that where you might get a little bit of context from that, because with this distance, we've got to be getting into some of them R levels. We want to see this attempt for the inside day breakout again. Otherwise, this is a really great example of a rally base drop. And that leg out of the drop is exactly what I like to look for when I'm looking at liquidity and zones like this. One, it's really fresh. We're not going out to a higher time frame and marking something from last week or last month. And two, the way that we left the zone, we want to see that there's unfinished business, right? That when we come back up in here, that there's going to be real active engagement, that there is liquidity up here and unfinished business, and that we don't necessarily want to call it resistance, but it's going to be a zone that we're going to have to get through, and it's very likely going to take a while, right? So this is going to affect a lot of things. Plus, it's a part of the whole rally base drop, or drop base rally, rally base rally, drop base drop, that whole system, right? So the problem is when you go marking systems like that, you can have overlapping levels, overlapping zones, and then that gets us tangled up in, say, which zone is more present, which one do we need to respond to first? Is it really going to react at that level, or is it going to be a deeper level somewhere else? So when it's one that is as clean as this, it has more weight to it. So otherwise, with this inside day breakout that we failed to get, has some weight to it. It needs to get back and give us at least an equal high, if not a higher high, or we're going to start that countdown of the 1, 2, 3 fail play. I didn't develop that strategy, but I've certainly used it before. Shouldn't be too hard for you to find more information on it. I was taught to use it with Bollinger or VWAP bands, right? So we got the VWAP here. We would turn the bands on and then look for, a failure to maintain when you're walking along the edges of the bands, and then you pull away from it, how you come back up to the bands and whether or not you get a retouch of those bands begins the count for the 1, 2, 3 fail. Since we're still getting higher lows here within this little range, we won't count yet. Although all of this just counts as a 1 because we need a lower low. All right, so we get a pullback. That sets the beginning of the lower low. We fail to get back up to these highs, come back down and set a new lower low, then we can count all of that as a 1. So that basically you get your run up. Pull back off of it, fail to get that high, and we're looking for a 1, 2, 3 fail. When you fail to get that high, if you don't get a new low yet and you're just chopping about, then it's still just a 1. So it's that lower low that matters for number 2, number 3, and then down we go. 1, 2, 3 fail. When it comes to the 1, 2, 3 failure, you don't always get all 3, right? It could be a 1, 2 and then go. It can just be 1 and go. It's a little more nuanced than just counting, how many times we fail to get back up here. We got to also have that lower lows. So 2 scenarios, we can run it through both directions. What if we fail to break out? Okay, well, we can stay sideways and just chop through this range between the daily pivot and yesterday's high. The entire day is a really big zone. So that would just narrow our focus down into a zone that's really very likely to be present, right? So from the daily pivot point up to yesterday's high, if we fail this breakout, that could be our entire trading day right there. If we do get through that daily pivot point to the downside, we're going to target this liquidity gap from yesterday that I had talked about because it's still not closed. Talk about unfinished business. Yeah. To get there, we would expand beyond the 21-day ADR half. Then be that red line right there. And we'd also be back inside the previous week. So right now we're inside week breakout and we are beyond the weekly expected move edge. Should we get through that liquidity zone and continue to go to the downside, we'll target the 10 EMA. That's the 10-day moving average, which we can see here on the daily chart. It's that light blue line. So right now on the daily, you can see that yesterday's cash open, or actually I should say that's the Globex open. Yesterday's Globex open is lower than the 10. So we'll bounce on the 10. And if we overshoot that, then we get to the Globex open of yesterday, which would be way back here, right? But that's if we can get through the daily pivot point, and all of that would assume that we didn't finish this breakout and get above. We do have a voodoo line up there, and it's one of the bigger ones. So when it comes to those voodoo lines, there's like varying degrees of strength, and that's why they're different colors and they're different thicknesses. So the weakest and the most common ones are these green ones, which I believe they call a forest. I never really got too deep into their nicknames on their lines, but then there's this kind of a light purple, like a lavender. And then there's the solid dark thick line, the white line at the top. All 3 of those are a part of the voodoo lines. So getting above 45.38 won't be an easy task. If we can get there at all, there's a lot of liquidity to work through. with yesterday's high and that beautiful trap to where we made it through there in the pre-market. Some analysts won't count that. They'll say, nope, the move has to happen in the daytime. Doesn't count if it's in the overnight. I'm not that kind of analyst, but there are analysts who will read it that way. To each their own, right? It's just not right. It's not wrong, but you have to be consistent. So if you count that as being hit and taken out in the pre-market today, then you want to always do that. If you don't do it today, then don't do it consistently. $10-day, 30-minute volume profile. Hey, look at that. The bottom. When we're at the highs, we go to the lows. When we're at the lows, we go to the highs. We weren't at the lows when we came up off of this bottom, right? The lows were much lower yesterday, the day before. So hopefully now that I have continued to do that multiple days in a row, it's starting to kind of sink in that when you look at this in the morning and it looks like we bounced off the bottom of the volume profile and rallied up, and that we're now at the top of the profile. Well, we didn't start on the edge of the profile and bounce up, right? By the end of today, this will be showing at the bottom of the profile, I'm pretty sure, unless we fall down, obviously. We don't have a classic shape here yet, so no D or P or B. And this shallow area really isn't going to be very helpful, other than the fact that it's really interesting. That's a round number, right? And psychologically, round numbers are really important. It's 4,500. It's the shallowest spot in the chart, which makes absolutely no sense whatsoever if you think about it. Other than the fact that we spent a very small amount of time there and we've got a whole lot of volume there. All right. So other than that, it's kind of odd that our shallowest spot up here is right at that round number. All right, no surprises out of the volume profile this morning. It makes sense that the greatest amount of volume is right through the bulk of where we've been spending most of the night. So no surprises. And we do have a VPOC from yesterday. We haven't hit it yet. We get a break to the downside and we are absolutely going to come into contact with that thing. And it's right at a cog line, 45.11. I'll just round up a tick. It's close enough. 45.11 is a cog line. So, we need to be prepared for that. COG, COG, center of gravity. It's not John Euler's center of gravity either, by the way. The person who called that a gravity point, I don't know if they knew that there was something already called a gravity point that Euler had developed, but either way, they were named gravity points or cog lines by somebody, and it stuck. But if you go searching for it on the internet and you go looking for cog lines and center of gravity, you're going to find John Euler's levels, not these COG levels. And unfortunately, COG levels, cog lines, are not done by an indicator. You have to go in and spend hours of work validating a level or a zone and proving that it is a cog line through the order flow. I went and did it now. Changed this watch list yesterday. Now I gotta find it. Nope, but that'll get us started. All right, so I just loaded the sectors up here. It's a little old school. Yeah, I know what they're based on, but they don't tell you how to do it, so you can't replicate it. Right? Like they got their videos on the internet that you can go and like go to YouTube and type in voodoo lines, and Steve will sit there and talk about what they're based on, but he won't teach you how to do it. Right? And so then you can't replicate it. So with everything being up this morning, I would have expected more. And the benchmark that I use is 0.5%. So with 0.5%, we got staples and technology, which is, I mean, when you think about it, that's pretty awesome, right? Because we got our risk on sectors that we have to have. We have to have finance, or we have to have tech. And with either one of those, as long as consumer discretionary piggybacks, we're all right. And that's the 3 risk on sectors. Generally, in the market we've had lately, it's been all tech with finance dragging its feet, or it's been all finance with tech dragging its feet. And we've seen the outcome of that, right? When finance is the thing that's leading the way, we might grind higher, but it's a choppy, nasty grind higher. But when it's tech and finance and consumer discretionary, oh man, it's a beautiful thing. But obviously, a rising tide lifts all boats, right? So if you can get 7 out of 10, 8 out of 10, 10 out of 10 sectors all moving to the upside, even if it is, defense and staples and utilities and but everything all going up, well, then it's going to be a much better trading day, right? And you don't have to be so picky in particular. You won't need special fancy scans. You can just throw a dart at anything that's going up. It's pretty easy trading. So I like the idea that consumer staples is up this morning. It was up past that 50% mark. I bet it'll come back up again. So we got communications, technology, some defense, jets, which has just been on an absolute tear. Bitcoin. So when we start looking at, okay, well, what's not up? Well, the NY Fang doesn't move in the pre-market. OAX, that's, it's another version of the S&P. It's just the S&P 100 index. But just like the SPX, that's not a pre-market product, so that thing's not moving. IGV never really seems to get enough movement in the pre-market to even register a move, or no flow. Same thing with cloud. It might kind of drift with a different print, but you don't really see any volume there. So all of these top ones, other than the VIX and the dollar, those are not going to register anything. Bonds are up slightly, so still, the 60-40 still dead. Emerging markets, after the run in the China ADRs and KWeb, we kind of expect that to be a little soft this morning. And yet emerging markets might be off a little, but KWeb, man, is up more than 1.5%. So let's go take a look at those, because too far too fast starts to come to mind. All right, so we got BABA here. It gapped up. It's kind of topping out a little bit this morning. $95.26 in the pre-market. It closed at $94 flat yesterday. So Looks like we're still inside day breakout at this point. Yep, it needs to hold above $95.03 because that's how high it got to yesterday. And when it comes to the question of, well, is it going to continue? It's a runaway freight train at this point. You don't short into strength like that unless it's gone. So what Tasty did for a benchmark is they developed a strategy called the aggressive contrarian. To short this would be contrary, right? So aggressive contrarian. They went all around the United States and they taught this. They also did a lot of videos on it. So what you're going to want to do is hit up YouTube, type in Tasty Live, because it's not Tasty Trades anymore, right? Tasty Live, and then look for the aggressive contrarian trade. They had benchmark levels. I think well, I don't want to say the numbers because I'm not 100% sure, and I don't want to give you the wrong ones. So I'm just going to put a number there. Suppose it moves 10% in 3 days, right? It has distance and time as a metric that I just drew a line in the sand. If it moved that far, that fast, then you would short it. That's not their numbers, by the way. Again, I just pulled those numbers out of thin air, but that's what their video is going to give you, what their strategy was and what their benchmark was. So with BABA, I don't think it's moved far enough, fast enough just to short this on principle, right? Just like for GP, just because. Probably want to have a reason to short it, a signal to short it. So the signal to short could be either A, falling lower than it closed at $94, or B, falling lower than the low of yesterday and then going into it. And then there's always the third option of low risk entry, shorting it right at 95.5, or wherever we open up in the pre-market, or when we get into the RTH, wherever we're sitting, shorting it at its highest point, not because you have a signal, but because it's the cheapest out of all of the risk. It's the least dollar risk trade. It's not the riskiest, right? So you will risk less money shorting it from its highest point, but it is a risky thing to do because you don't have a signal yet. Otherwise, if they continue this expansion, then we could, just like snap a trend line here, call that resistance. We'd have to get through that level. That is a really wide, kind of a sloppy, nasty inverse head and shoulders, isn't it? It would very likely take another 1.5 years for that big old pattern to unfold. When I'm here on the weekly, however, you can see the TRB setting up, right? For those of you that know my strategy. Just nice and sloppy. So if you can, connect those two lower legs, these lower highs, connect those two, you're getting your breakout. Got to follow through to 100. There's that old market phrase, if 80, then 100. Right? It's not mine. I didn't make that up. It's been around for a long time. So 100 would be the target for a swing from 94. That's not bad. But you're taking it after a really big move already. And you got to kind of sort of ask the question like, is it worth the risk to try to go long from here? If you did want to go long, your low risk entry, I guess you could use the pivot point from yesterday, right? At 95.03, the high point. Keep it above that, right? If it falls below that, I wouldn't try to keep my long. And it's not just BABA this morning, it's the China ADRs, right? So you got Baidu, BABA, JD, PDD. All right, so we know that they're all doing good. The thing is, they were doing good, right? They had one solid, fast pop, which was just the algos balancing the basket. And that's it. We haven't really got a whole lot after that, right? Okay, well, PDD, after the algo rebalance, it just kept going, right? So there's that one. Volume's looking pretty good for the cumulative overnight. I think it was DAL that had news this morning on I was listening to it on the radio. So the airlines, not just DAL, that thing was up like 5% earlier. See, we're gonna close way down there. Yeah, 4.5% ish. So here on the monthly, big, massive pattern that would take years to unfold. It's not really helpful, but what is helpful is this 52 and a 52 flat, maybe 52 and a half is a serious level of resistance. It was support back in, 2019. Old support became resistance. It's still resistance. I haven't been able to make it through there. So kind of keep that in mind. We are up this morning at that $50, 50.20. We faded back to 49.80. We're right in the thick of it. We are really close to a level that I find it very hard to imagine it's going to get through in a single shot. I think it's going to take a couple tries. So the distal line still not touched, but the proximal line has been breached. That's 49.47. We're above that this morning. I would certainly think that's going to be some form of support. So worth keeping your eye on. If we fade back, you want to find that support at 49.5 and then get the follow through. Look at that. If we consider with Delta Airlines, it's got the earnings, it has the big pop up, but it was a perfect bounce off of the 10 first, right? That was yesterday. So it came down, closed with a bounce on the 10. And now this morning, it's going to be opening above it. You can use that high of $49. That'd be yesterday's high. But I'd say as long as it holds above 48.7, you're good. If you want it to be aggressive, it needs to stay above 49.50. And 52.25. I mean, that's it. I don't think you're going to get through there very easy. It'd be a nice target though, if you were to say get options up there. They'd probably be cheap. And they're about $1. You can see they're building a position at 50 and 55. And these 52.5s probably just came in. I bet if we go and look, they're not very old. That would explain why there's so little of them. So $5 wide debit spread out of the money, risking $1.22 is what you spent. So it's what you can lose. 64 days to expiration, so it won't move crazy super fast. The problem is, don't buy it first thing this morning. Options IV goes up as we go into earnings, and then it gets crushed on the other side of it, right? So let it get crushed. You could probably get this a lot cheaper, say 10, 10.30. Let them crush the hell out of these options first. See if you can get it a little cheaper. Getting it for less than $1 would be good, right? Because then you're risking less than 1 to make more than 4. And of course, all the airlines are going to be kicking off soon. Banks kick off on Friday. They're going to be starting, the new quarter. They generally set the tone too, so it's worth keeping an eye on how they do. They're not all going to be done by Friday, by the end of the day, but a lot of your biggest ones will be done Friday. So when it comes to today with the S&P and the NASDAQ, this so far is not looking like a rug pull gotcha. I'm not seeing any warnings in here. Nothing that says they're going to drop this on our head or pull it out from underneath us, right? So I wouldn't be trying to short the S&P and the NASDAQ today just because. I know it seems like we've gone a long ways in a short period of time, and that makes it ripe for a short, but there's nothing here. Every single sector that we would consider important is up. And then extra ones that we don't even consider important, they're up too. So pot stocks, EV markets, electric vehicles, airlines, Bitcoin, semis, right? You go down through the list and none of them are showing a negative. So until one of those do, preferably 2 or 3, I wouldn't try to short this thing. The 3 that matter for the risk on is finance, technology, and consumer discretionary. If you go in and you look at the biggest names in each of those, then you'll know which stock names to watch. For consumer discretionary, obviously, is Tesla. So you can do it by the sectors themselves. You can do it by the names that are making up those sectors. And the more sectors that you have running in the same direction, the better. Yeah, it's a complete risk on day. I'm gonna leave you guys with that. If you try to short anything, I would just approach it with real caution, right? Because this is not looking bearish at all. And the fact that we're not up massive goes with that, right? If we were up, 2.5% in most of these things, I'd be more concerned. But we're barely up. And now we're back to an inside day breakout. How we resolve this high is going to make or break the rest of the day. And that's 45.25. So I'm sure if we go to look at, tier 1 alpha or trading ticks or, one of spot gamma, and we look at those levels, I wouldn't be surprised to find that level on there. We got a cog at 45.31. And then we've got that voodoo line at 45.38. Everybody be careful, be safe. I will see you all tomorrow.